Okay, a market outlook. It looks different, doesn't it? That's because I came back to Canada and I can't get my system to recognize my Syntic, this new system that I have in Canada. My complete setup is in Costa Rica. So for the next 2 weeks, we're going to have to find a workaround. And so I've imported everything into Microsoft Word. I don't have anything that I can write on the screen with, but we will scroll and I will narrate. It was pointed out that I didn't do a Q&A this week. I was flying back from Costa Rica on Wednesday, got here late Wednesday night and had to set up my system for 2 live sessions, level 3 mock exam sessions the next day. Couldn't get it to work. I finally had a Serify IT person who lives in the area in Canada come over and at least get it working in Firefox. Did not have time to do a Q&A, but what I will do this evening at 7 o'clock Eastern Time, Sunday night, this is February 4th, 7 o'clock Eastern Time, I will do a live YouTube feed. And I will go through those questions and then any questions that show up in the chat. So I think that's a good trade-off. In the meantime, this is all I got. So let's go. I have my mouse, so my mouse can point at things. If we look at money market rates, kind of a little odd thing going on with the 1 month and the 2 month, but that's okay. And out to the 6 month, out to the 1 year, rather well behaved. And then from the 2 year onwards, we see that we have a flattening of the curve, more inversion. Look at the inversions here because you do have a flattening, so we have more inversions. May seem odd given the damage that TLT took on Friday with that jobs report, and we'll have a look at the jobs report. Another big discrepancy between the household and the establishment, and even within the establishment data, it's not that good. So this happens every January, and then we have to look at February, March, and then there are revisions which tend to correct that. But TLT did have a good week. Week over week, it had a good week. Week over week, it would have had a great week if Friday had never happened. If you had a jobs report under 100,000, I think we would have had a fantastic TLT week, but still up, I think, over more than 2%. So curve conversion is still in place. We look at the number of days between the 2 to the 10, 571 days, 3 month to the 10 year, 458 days. The SOMA really came down 40 billion, almost 41 billion. Look where we are. Just a little over 7 trillion. I said sometime in February we should be printing a 6 handle. Next week, there will be a 6. Well, hang on. Are there any maturities over the next week? There might not be any maturities, which means we might not see a 6 till the week after. But fingers crossed, here's hoping for a 6. Fed balance sheet down to 7.63 billion from 7.66, down 47 billion. The SOMA was down 40 billion, so there was a net decrease of 6.25 billion. The bank term funding program down 2.53 billion. The TGA up 41 billion. The Treasury is really pulling in the money now, up 41 billion. Reverse repo, another new low for the week, 513 billion. Maybe next week we'll see a 4 handle on there. At this rate, we're probably going to print a 0 on the reverse repo, probably by May or before May at the rate that it's dropping. 513 versus 570 the week before. The lowest was 503. That was Thursday. It tends to, sort of punch up going into a weekend. 503. I don't see why that would reverse when if we look up at the T-bill rates, the 1 month, the 2 month, the 3 month, there's plenty of money market securities offering more than what the Fed is paying on the overnight reverse repo, and there's plenty. And I believe that the SOFR rates, the repo rates in the repo market, without going through the Fed, that the rates in the repo market are higher than the overnight reverse repo. So I don't think that it's really needed. And as soon as this hits 0, what gets hit next? What starts to drop? Because assets keep dropping, some liabilities have to drop. If this liability is not dropping anymore, it's going to have to be this one. Reserves. And the Fed wants to operate in an ample reserves regime. What was interesting in the press conference is he did say that at the next FOMC, they will begin a serious conversation about the balance sheet. Because I think they're seeing the same thing on the reverse repo, that once that hits zero, if they're going to continue balance sheet runoff, it is going to run off those reserves. And the last time they sort of had some idea of what ample was, the cutoff was about 2 trillion. So maybe that's higher now by like 2.5 trillion. So that you really don't have a year of balance sheet runoff to go before you hit what they believe might be where ample is. But we'll get that in May. Reserves are down 78 billion. Money market fund assets, look at this. Everything over the last 2 weeks is reversed all in 1 week, up 41.68 billion. Retail up 8.62, institutional up 33 billion. Government, between the two of them, government money market funds up 30, prime up 7. The Fed, this is the March 20th, the probabilities for March 20th, which we get in 45 days. That meeting is in 45 days. That whittles down fast. It sounds like a long time, 45 days. The probability for no cut, 62%. And he was clear in the press conference where he said there is no chance of a rate cut. I don't know if those were the exact words, but his message came across clear that those looking for a rate cut in March are wrong. They're not discussing any rate cut in March. In fact, it's going to be zero. So that'll move slowly to 100% over time. But 38% probability is not an insignificant probability. That's got to be more than just hedging. 38% on at least one rate cut. Let's go to June. 5.5 to 5.25, implying only one rate cut, 5.1%, 50% on at least 2, but no more than 2. So you're somewhere around 56% on 2 or less, and 44% on 3 or more. When we get to December 18th, look at the high end of the range, 4.75. That is exactly 3 rate cuts. So they believe, the market says, okay, we believe the Fed, there'll be 3. Here you go, 0.3%. That means what the market is saying here is that at least 4 for sure. We'll give the 3, but we think it's going to be 4 for sure. And then we have some distribution of probabilities for the end of the year. If we look at, that's a little bit later on. It's down here. So let's just leave it at that. There's the distribution of probabilities. For June, we're starting to see that the 3 rate cuts it had by June, that the market is less willing to accept that. When we look at the number of cuts implied by the Fed funds futures, last week was about 125, 5 rate cuts. We're now at about 4.5 rate cuts. So the Fed says 3, the market's at 4.5. It's like, well, okay. A couple of weeks ago, the market was at, 6 1/3 cuts against 3. Now it's 4.5 against 3. And at that time, I did say that a short on the Fed funds futures for either June or December probably would have been a good play. And it was a good play. So let's see what we got next week. Bostic on Monday. I don't know why I'm yelling his name at you all in capital letters. My caps locks must have been stuck. But Bostic! Because I got to yell that one. Tuesday, Mester. And if you're watching Bank of Canada, Macklem. Wednesday, you have Kugler, Barkin, and Bowman. And Thursday, Barkin will be Barkin again. Real yields. Hardly any move on real yields. Nothing much to talk about here. Look at inflation expectations, or the break-even rates between the real yields and the nominal yields. They are dropping. It seems odd to me because everyone, for a long time, everyone was paying attention to average hourly earnings as a driver of inflation. And average hourly earnings this week came in hot, almost 7%, 6 point something percent. If you take the month over month and you annualize it, you're almost at 7%. that I thought when I was doing this, I thought I would see inflation expectations increasing, not decreasing, but there we are. Fed funds futures, you can see the blue curve. This is just Friday. This is just what happened on Friday. As of Thursday, it was basically week over week, almost unchanged in terms of where the expectation of rate cuts would be. This is just week over week. It all came out in 1 week. June sitting at 95.185, implying a rate of 4.815. Given the effective federal funds rate now of 5.33, that's 51 basis points lower, or 2 cuts by June. And March is off the table, which means you're going to have to go cut. 2 cuts right after that. I don't know if I'm there. I don't know. September, going from the end of June to the end of September, Q3, another 2 rate cuts, 46 basis points, and then a little bit in September there. 115 basis points. I call it about 4.5 rate cuts. A little more aggressive than 4.5 rate cuts. 4.5 rate cuts would be 112.5. Let's call it 4.5. But what was it? 3 weeks ago we were at 6 1/3. We're down to 4.5. Fed sitting at 3. March we get another summary of economic projections. So I think TLT will be range bound until then. We hit 98.50 last week. I'm jumping ahead here because we're going to see TLT shortly. I did sell some $100 calls. I didn't get much. I got like 62 cents on the $100 calls, but I just didn't feel it. So I thought, well, I'll grab it. If it's called away, okay. It's called away. It'll be called away at a price greater than what I paid. It'll allow me to go into something else. But I sold $100 calls again. Not for a lot of money. And then Friday happened, and I thought, okay, well, I mean, there's that at least, right? There's CLT. Look at that. Look at that drop. And all week long, this thing was chugging along nicely, and it just kept going up. Look at this big day here. Up we went. And then the jobs report came out, and it was like, nope. And down we went. So I had sold calls the day before. A little early, I think, because the market, TLT, still kept going up. I'm looking at the calls going, why didn't I just wait? Why didn't I just wait? It was a good chart. I should have just waited, but worked out the next day. TLT up 2.44% week over week. Even after that ugly Friday, you would think, well, that sucked. But still up 2.44% week over week. Was a good week for TLT. Held its ground quite nicely. SPY up 1.42% week over week. All-time highs on Friday closing. All-time highs. Didn't close at the highs of the day on Friday. It gave back a bit during the day Friday, but still managed to close out that week. And I'm going to suggest a lot of it was Facebook because it really had a day. Look at mortgage rates, down 6 basis points. This is a Thursday over Thursday, so we don't have the benefit of seeing the Friday in there. The 10-year Treasury, Thursday over Thursday, down 27 basis points, and the mortgage rate's down 6, so spread up to 276 basis points. I think the widest spread that we saw this cycle was 308, 309, something like that. I don't have the housing stocks and the mortgage REITs. I didn't update those because this was just taking a long time to do, and I thought that's a really tedious thing to do. I'll let it go for a week. We're going to talk about one of the regional banks and commercial real estate. We'll spend some time there. OAS, all of them widened, but not to the point of alarm bells. All of them widened, but not a lot overall. But we have that. OAS just hasn't been a source of much information. The only thing OAS has been saying for these past 2 years, after we got past the cycle highs, which we see across the top, the only thing the OAS has been saying is move along. There's nothing to see here. Move along, and that's been it. New York City Bancorp. Look at this. Bang. They had a loan loss. An actual loan loss, $185 million, and then increased their provision by $500 million. They have over $100 billion in assets. Just keep that in perspective, but still $500 million on the loan loss reserve. Not in loan losses, but as reserves against future losses. Now, it's hard to determine what's going on with New York with regional banks, because this bank swallowed up two other banks and surpassed the $100 billion mark, which means it's subject to a whole bunch of different ratios and requirements. That's a lot to get done in a year. So could it be that it's just managing their transactions that is causing some grief? I don't know. The loss that they had came from two loans, came from only two of their loans. Didn't help the KRE, though. KRE dropping significantly. This is last year, SVB and all that stuff going on. And then, of course, you have sort of a little bit of a bounce, and then you always have this kind of step down before you really start to go. And then from there, it just seemed to have recovered. We got all the way into the 50s. This was down in the 30s, under $40. I can remember when it was there, I was selling $36 and $35 puts, thinking even if I have to hold it for a while, this will pass. This is I don't mind holding it there. And I just got out too early. It continued to run in the 50s from over 52.50 down to 48.20. An index, an ETF. When I say an index, an ETF, which is tracking an index, but an ETF to drop that much, that's big. And if you were watching ABR suffered from all of it as well, because ABR is multifamily. I'll say more about that in a second. Let's just do some reading here. In the case of New York City Bancorp, it was largely one office loan and one co-op loan that were responsible for a steep rise in net charge-offs to $185 million from $1 million in the year earlier period. It also set aside $552 million for future loan losses, a sign it expects credit to deteriorate further. Now, remember, it crossed the $100 billion threshold in assets, and it increased its loan loss reserves by $500 million, which is 0.25% of its assets. It's over $100 billion in assets. You kind of got to keep that in mind, but it's comparing itself against last year when it did not swallow up two other banks and massively increase its assets. It's not a fair comparison, the 185 against the 1 million. Still, there it is. But again, on the counter side, it really was only two loans. There were other reminders Thursday outside the U.S. of the potential for more problems to come. Germany's Deutsche Bank and Japan's Aozora Bank disclosed new commercial real estate weaknesses Thursday that stoked investor concerns. And we know that Evergrande in China has gone the bankruptcy route. And it's no secret that office is under pressure. And in the U.S., multifamily is not as healthy as Canadian multifamily. In fact, Canadian multifamily is on fire, or at least it should be on fire, based on prices we're seeing for REITs. One scratches their head and says, what's the Canadian market thinking? There you do have a massive shortage. So there we are. The screenshot below it, asset quality. This is from their press release. Non-performing assets were $442 million at December 31st, 2023, or 0.38% of total assets. 0.38, $442 million. That's a small number, 0.38. So you could say, well, $442 million is big, but it's only 0.38. The other way, the more pessimistic way of looking at this is saying, yeah, that's right, it's only 0.38, and look how big that number is. Imagine if it was 1%. Can we live with all of these numbers going to 1%, which still isn't a lot? What if it's 5%? What if it's 5%? That puts a lot of these guys out of business. Non-performing loans. You have non-performing assets, non-performing loans, $428 million. Which is 0.51% of total loans. The allowance for credit losses totaled $992 million at December 31st, 232% of the non-performing loans and 1.17% of total loans. 1.17%. $992 million. 552 of that came in the fourth quarter alone. So we see the next bullet point. During the fourth quarter, the company recorded a $552 million provision for credit losses compared to $62 million in the previous quarter. That is kind of comparable if you go the previous quarter. If you go year over year, it's not going to be comparable. Net charge-offs were $185 million during the fourth quarter. That's loans where they're saying, it's over, man, it's over. 185 million during the fourth quarter compared to 24 million in the third quarter, driven by just 2 loans. So we could look at this 2 ways. You could say, well, look, it was just 2 loans that did it. And the other way of looking at it is saying, yeah, look how much damage just 2 loans did. Imagine if there's 2 more or 4 more, how much damage it could do. If 2 loans did that much damage, so there's the pessimistic side. The optimistic side is saying, hey, of all the loans we have, it really was only 2. That's not so bad, right? You can look at this one both ways. There is a very bearish interpretation, and then there's a not so bearish interpretation, but a more, one that says, look, here's the reality. We're going to have some charge-offs. Interest rates are the highest they've been in 2 years, and they're going to be here for a while, and all we've suffered was 2? That's not so bad. It depends on how you look at it. How do we compare this with ABR? ABR has a significant asset base. They're not required to meet any liquidity or reserve requirements. However, they're not a bank, and they have a different type of clientele. I can remember it was a while back reading some research on private companies versus public companies. This was in the entrepreneurship literature. And it was about inventory levels with private and public companies, that private companies tended to carry higher inventory levels. And there were 2 competing theories for why would private companies carry higher inventory levels than public companies. And one was that private companies being owned are far more responsive to their marketplace. Whereas public companies, because of the separation, were less responsive to the marketplace, so they were more beholden to models of minimizing inventory holding costs, whereas private companies were trying to maximize customer service by having inventory on hand when customers wanted it. The troubling thing is when you dove deeper into the type of inventory, you saw that private companies were very reluctant to have an inventory charge-off. Were very reluctant to sell inventory below their cost, whereas public companies, once they realized that inventory was going to sell, were more willing to sell it below cost, because their thinking was, if I paid $10 for it and I'm trying to sell it for $20, if I have a 50% off sale and it's not moving, I have $10 that's not moving. It's better to sell it for $5 and then buy something for $5 that I can sell for $10. I can recover my $10 faster by taking a loss here and making it somewhere else. But private companies were more hesitant to sell something below a loss. They were making more emotional decisions than rational decisions because it was their money. They were very connected to every single dollar on the balance sheet. So let's look at regional banks versus something like ABR. Regional banks would most likely be dealing with probably corporate borrowers, whereas ABR is probably dealing more with private borrowers. Based on how they describe their book, it just seems that would probably be the case. And looking at some of the REITs that have walked away from certain deals, there's always a bank on the other end. And a REIT is probably far more willing to walk away from a bank by doing some calculations saying it's cheaper. Yes, we're going to lose money, but it's cheaper to lose money on this than to put money in and try to save it. Whereas individuals, they're probably far more willing to do capital calls when it's their own money. When they don't have investors, in other words, they say, look, it's our money on the line, it's not investor money, they're probably more willing to make the emotional decision of meeting a capital call. We'll find out. Arbor reports next week, and 2 things we're going to look for in Arbor's statements. It's the annual, which means it's audited. All the quarterlies were unaudited, and there was some question about a particular transaction that Arbor recorded. If it doesn't pass the auditor, you get what's called a fourth quarter adjustment. And a red flag for almost any company is a lot of fourth quarter adjustments, because that is the auditor stepping in saying nope, nope, nope to all these other things that happened at the quarterlies that are unaudited. Unaudited. Only the annual is audited. So what fourth quarter adjustments will we see? The more adjustments there are, the less confidence you can have in management's quarterly statements. The more suspicious you become. The fewer adjustments there are, if there are no adjustments, then you can feel pretty good about the quarterlies. It would seem odd that if you're going to do a particular type of transaction, you would not at least throw it past the auditor for an audit opinion, even though they're not audited statements. You'd probably still want to get an audit opinion so that you don't have a fourth quarter adjustment. But we'll see. The other big thing is, what are the loan loss provisions in ABR? Now, they've been very clear that they're in the worst of it. That they do expect for the next 2 or 3 quarters it's still to be rocky. They were very clear on that. Let's see what happens. I don't think they report this week coming up. I think it's next week. I think it's next Thursday that they report. Or next Friday. It's either next Thursday or next Friday that they report. I'm not sure which of the dates, but it's not this week. We'll find out next week. But I'm continuing to hold until I see a reason why I shouldn't hold. If I see a lot of fourth quarter adjustments and their loan loss provision, the auditor forces them to really increase the loan loss provision, then I think it's pretty much over. That even if they take a hit on the opening, over the next couple of quarters, they would move lower anyways. I could step out and probably grab them $3-4 lower. We'll find out next Thursday. But this, I think, is not done. It is hard to tell whether this is a New York City Bancorp story in them trying to digest too much too quickly. But when you combine it with Deutsche Bank, when you combine it with Japan, when you combine it with Evergrande, and idiosyncratic stories here and there, is 2024 going to be the year of commercial real estate implosion? We are hearing there's something like $2 trillion of commercial real estate debt due over the next 2 years, and you have a Fed saying, we're not cutting rates as fast as you think we're cutting rates. So it may give some property owners, that reason to say, okay, well, this really would have helped us. We hung on for as long as we could. If there was going to be a rate cut in March, maybe it would have helped us. But if it's not going to happen, and at March, if that's not going to happen, by June, I don't know that we can hang on. We might see more of that. And with the Bank Term Funding Program ending, well, it might get interesting. I think this is a story that we can't shove away. I remember in 2007, Bernanke in front of Congress being asked about the subprime crisis, and everyone knew there was problems in subprime mortgages, but everyone felt it was contained to the subprime mortgage and that it wouldn't spill over. That it was contained to that market. Even Bernanke himself said, we don't see any spillover effect. We think it'll be pretty much contained to that market. And you couldn't have been more wrong about that statement. That right now, I don't know that there's enough concern about commercial real estate. Could it be just contained to the regional banks, and that's it, or will it spill over to the broader market? I mean, I don't know. To be hitting all-time highs on the market while this is going on, while this is the backdrop, to be hitting all-time highs is just one of those, there's a disjoint, and it just doesn't feel right. It feels like the market is saying this is going to be contained to its own little market. No spillover. We'll see. Let's go to SPY. Look at that run. Look at this. It is just going straight up. You just draw a straight line under that, just going straight up, all-time highs. Fourth quarter operating earnings, both LSEG and SP Global are down, 241.97 versus 242, and 238.95 versus 240. Not falling off a cliff. I keep saying this every week. They're not falling off a cliff. They're just going in the wrong direction. So closing SPX was even higher. 4-quarter operating earnings were even lower. So we're now at 20.62 times forward operating earnings. That's not forward reported earnings. If you go to forward reported earnings, you're somewhere around 23, 24 times. This is 20.6, the operating earnings, versus 20.28. And SPY hit another all-time high at 494.35. That was the closing. If you're looking at the chart, it's showing 493.61 because this is this chart has after hours turned on, which means the chart will record after hours moves on the chart. It won't just end at 4. And volatility, almost non-existent. Volatility down at the very bottom of the screen here, you're looking at somewhere around 11%. This is a big round of volatility back here. Way back here you see volatility, but we're almost near the low. No fear, all-time highs, multiples pushing up now towards 21 against the backdrop of what's going on with commercial real estate, which is not just located or localized to the U.S., but globally. And when you think about the price, just of the price of housing, and you look at what the national income per person is, you scratch your head and you say, something somewhere has to give. Could this be that big bubble that bursts? Could it be just that commercial real estate breaks and then sort of just bursts everything else? I don't know. But to have no fear, to have no fear of it, to me is the curious thing. Anyways, let's have a look at the jobs report. Let me see if I can find this one now. And I can't, because I'm doing Vimeo here, I can't just end it. I have to do this kind of thing, and I have to find where it is. Where would I have put it? Let's see. I have to do this carefully here. Employment situation, here we are. Let's maximize this one. All right, so here's the employment situation, the report that we got. Let's go to the first table. The first table will give us household data, and we can look at employed, and we can read across here, 161, 183, 161 million, 183,000 in December. 161, 152 in January. So what is that? That's negative 31,000. Negative 31,000. This is interesting as well. Look at your civilian labor force. 167,451 has now dropped to 167,276. It's been dropping every. If you look at January 23, 165,871. Oh, sorry. You got to go to November, 168 down to 167 down to 167, but year over year it's up. Okay, that's January 2023. November dropped in December. December dropped in January. That's rather interesting. The participation rate, 62.5 held constant. Let's go down to the establishment data, 353,000. Goods producing, 28,000. Private service producing 289, and if we look for temporary help services, they've been negative for some time, 3.9. This gets interesting down here. Average weekly hours, big drop, 34.3 down to 34.1, but average hourly earnings, a big increase, 34.36 to 34.55. On a percentage basis, annualized, it's high sixes, pushing 7%. That's a big number. If we look at average weekly earnings, because this will tell us the level of consumption power, 1178.55, 1178.16. Because of the drop in earnings, the combination, not the drop in earnings, sorry, because of the combination of the drop in weekly hours and the increase in earnings, you have the average paycheck going home with less money. With food costs that, because I've been out of the country for 2 months, I came back here, went shopping, I was looking around, I said, what happened? In the 2 months that I've been gone, what has happened? The food prices, I couldn't believe the prices I saw. that now it's cheaper to buy food in Costa Rica where it's all imported in than it is here. I'm looking at it thinking, what happened in the last 2 months? What's going on? It was rather shocking. Some things that I can remember being like $5.99, because I used to buy it all the time. $5.99. I'm paying $6.49, $1.50 higher. Thinking, you get it home, you open it up. It's this kind of like granola flaxseed thing that I put in yogurt. It was always $4.99. It's $6.49. Open it up. I'm thinking, why is it smaller? It's a smaller bag. 30% more in price, and it's a smaller bag. And it was shocking in just 2 months. So I don't know about the consumer purchasing power without credit. We get that report this week, credit growth. I think that's from the New York Fed. We're going to get that. That'll be interesting to see, because I think the last time was credit card debt had surpassed $1 trillion. For the first time ever, had surpassed $1 trillion. Let's see what's going on there. Diffusion index, look at this. Total private went from 64 to 65.6, meaning expansion. Manufacturing, big, 51.4 to 59. It went from 42. This is just in November. 42, meaning no hiring, actually more companies reducing their workforce than increasing, to almost even to no, more companies increasing than reducing, 59. Let's look at some of the other tables in here, and I got to scroll to find it. We're going to look for, not that one. Just bear with me, I'll find it. Here we are. This is from the household data as well. Full or part-time status. If we look at total 16 years and over, January, this is employment, 161 million, 152. So full or part-time should add up to that. The part-time is stated on a full-time equivalency. We went from 133, 196 for full-time down to 133, 133. Oh, 133, 133, look at that. That's a drop of about, what is that, 66,000 in full-time. And if we look at part-time, 27,794 to 27,890, an increase of almost 100,000 on the part-time, decrease on the full-time. Fewer hours worked, more part-time than full-time, and the household survey saying jobs are lost, not gained. We're not going to see corrections on that for some time. And I think there's one more thing to look at in here, and I just got to find it. There's so many tables. The U6, it's at 7.2%. U6 is a broader measure of unemployment. If you read it, total unemployed plus all persons marginally attached to the labor force plus total employed part-time for economic reasons as a percent of the civilian labor force, plus all persons marginally attached to the labor force, 7.2%. Where am I looking here now? Just bear with me. This is all the industries by detail. I think there was one more. Average overtime hours is what I'm looking for. So if we look at manufacturing, durable and non-durable, we went from December 2.8 down to 2.7, and durables here 2.9 down to 2.8, non-durables flat. So average hours per week has been dropping. Average overtime hours have been dropping. Consumers going home with less pay, and the household survey says we lost jobs. The establishment survey says we gained jobs. Which one is correct? I think each one has something to say, but in time we'll see the revisions. One thing that we will get next month, at the end of next month, that helps us a little bit, is GNI. When we get our first look at GDP, we've had fourth quarter GDP. We get our first look at fourth quarter GDP. All we get is GDP, which means aggregate output. We don't get aggregate income, and there is an identity in economics that says aggregate income must equal aggregate output, because aggregate output is counted as all of the value added. Well, all of the value added is the income. So we had very strong GDP. We'll see what gross national income is. We only get that, unfortunately, next month. We have another week of corporate earnings coming out. This week was a big tech week, so there's I think something like 90 to 100 next week as well that are reporting, and then after that it starts to drift away. It starts to drift down, but we're nearing the end of the earnings season. Once you get to about the second and the third week in February, it trails off. That I think it's pretty much done by, I think, first week of March you might have one or two laggards. Second week of March might be one or two, and then it's done. That is the weekly outlook for this week. And again, I know it might be a little unsatisfying, simply because it's not the same as going from screen to screen. I can't write on the screen, I can't draw on the screen, but it's going to be this way next week as well. And then the week after, I'm back in Costa Rica, so I'm back to my regular thing. However, just a reminder, as of 7 o'clock tonight, I will do a live feed on YouTube, and I will answer the questions from last week, and of course any questions that come this week. And let's see if we can end this. By the way, if you're wondering how I did this, it's Vimeo. You can go to Vimeo and you can download their Vimeo Live, and once you're done with the live thing, it uploads to your account on Vimeo. You'd have to create an account on Vimeo. When I'm done, it'll upload it to my account on Vimeo. I'll then have to download it from Vimeo, and then I can upload it onto YouTube. But if you're wondering how to get it done for free, open a free account with Vimeo, and you can do this kind of thing. What you cannot do is stop. So when I do the market outlook, sometimes I do a screen 2 or 3 times, because I'll finish narrating the screen and I'll think, I didn't like the way I did that. I could have been a little bit more clear. Here, it's one pass. I can't stop and add, stop and add, stop and add. As soon as you hit stop, it creates a video, and then that's it. You're done. So that's the only drag about it, the only disappointing thing about it. Other than that, that's it. Okay, I'll end here.